my view of the 60-70 range is gone. I no longer have that view. I now think you could go to 100 to 200 in the next couple quarters. We've done a lot of technical rationale for that. It's not just a gut feeling, okay? But we've shown that if you look at silver on a chart, just an arithmetic chart, go back to 1975, when gold was legalized. Gold has had huge surge up, then a pullback and a range for a decade. Then another huge surge up and a new higher range for a decade plus. And now is into another surge, which is, by the way, only half as strong so far, measured logarithmic scale, ratio scale, to the prior two bull markets. If gold matched them, it'd be $8,500. Okay, but how come silver is stuck in this box for 50 years? We showed charts of copper and lead, okay? Real exciting stuff, lead, But in the 70s, 80s, 90s, and into 2000, they were stuck in a range, sort of like silver is now still stuck in. And in 2005 and 6, copper quadrupled in about a couple quarters. It just left that old reality behind. And then over the subsequent decades, a new range that if you divide the middle of that range it's lived in for the last 15 years or so, it's 4 times what it was between 1970 and 2005. Okay, how come silver's still stuck in that range? Then we look at lead, and lead had the same situation for multiple decades, caught it at a price range, blew out of it in 2007, not in sync with copper on its own stuff, quadrupled in price in a matter of a couple quarters, and then lived in a new reality, way above that old reality. How come silver's here? Well, there's some arguments that are likely valid that, it's been artificially depressed, suppressed, etc. But whatever the reason, you can't fake reality forever. And if gold, the other monetary metal, has gone from, a peak in 1975 at 200, then in 1980 was 850, and now we're 4,000. And yet silver in 1980 was 50 and we're at 48. Okay, now something's wrong there. Forget any intricacies of special situations. What's going on? I mean, lead's 4 times its price then. Copper is silver, anyway, there's a point to be made there. Sometimes markets make mistakes. We know that. As an investor, if you're around long enough, you've seen bubble markets make a peak. And when it falls apart, you look back and say, oh, golly, now I can see why. It was irrational, too high for too long. Even if the concept underlying it was valid, it just went too far too long. And the same thing goes on the downside. Markets make mistakes on the downside. They get down too low. They lay there. Nobody likes them. They're not doing anything good. So who's going to invest in them? And then when they wake up in a thunderbolt. The technicals of silver right now argue to us. Now we've got one trigger level that we'll talk about in a minute, that when it's triggered, we think over the following 2 quarters or so, in other words, 6 months or so, silver could go to at least 100, more likely to 150 to 200. In other words, you could quadruple its price in a matter of a couple quarters, doing the same thing that's been done in many other markets over the past 50 years. Here, there, so forth. And the technicals justify assuming that. It's not just gut feel. Okay. And anyway, that's what we see. So the 60-70, forget it. No, we don't believe that. Much higher. My own personal investments, which I have to disclaim at the end of all our reports, is what do I own? Okay. I'm wholly emphasizing silver and silver related. And I think some of the miners might be as much bang for the buck, if not a lot more, than what silver might do. And the reason is they're still very lagged to the gold miners historically. They're very lagged to almost any way you want to measure to gold. Or the silver miners are the real dogs. The gold miners have gone up, and notice GDX, for example, had a high in 2011 in the 60s. Well, it went up to $80. Okay, pull back, and right now we're like 68 or 70. I think we're 70 area. Okay, so it had a pullback, but it burst through this at like a doubling in price in a matter of a handful of months, just to get above 2011 high, which is, we know gold's way above that. It was $1,920. Okay, so the gold miner said, I'm here too. I'm back. Okay. The silver miners aren't above that high. For SIL, for example, that high in 2011 was at 90. We didn't get there. I think we're going to get there and then some. I think it's, again, sort of the phenomenon. I'm talking about what I think silver's going to do technically. The silver miners perhaps should best be viewed not as miner by miner by miner analysis, but more as, hey, They got the stuff underground and it's not priced at even the per ounce level. Okay, you're in effect buying silver bullion at 10 cents on the dollar, okay, by buying the mines. And I think that acknowledgement will come when silver runs its tantrum move. It goes to the new reality. And I think at that point, you want to be long silver, perhaps if you want to, silver calls that go out a year, let's say, and the silver miners, as opposed to gold and the gold miners, which will also be going up, but less so. So I think it's the focus now should be on the silver component of the monetary metals.
When I look at silver today, I no longer see the 60 to 70 range that everyone keeps talking about. That view is gone. The structure of this market is screaming something far bigger based on our technical work, not gut instinct, not emotion, but decades of quantitative analysis. I now think silver could go to $100, even $200 within the next couple of quarters. That's not hyperbole, that's math. Let's walk through it carefully. When you step back and plot silver's price since the mid-1970s, you start to see a strange and almost eerie picture emerge. Go back to 1975, right after gold was legalized for private ownership again. Gold surged to $200, pulled back, consolidated for years, and then exploded higher into 1980, an eightfold move. Then came another range, another long consolidation through the 80s and 90s, and then another massive breakout in the 2000s. Every one of those phases represented a complete revaluation of what money meant in that era. And now gold is doing it again, except this time, we're only halfway through. On a logarithmic scale, that's a ratio scale, the only fair way to compare moves over time, gold's current bull market is only half as strong as its two previous bull markets. If it simply matched the average of those earlier cycles, gold would be trading around $8,500 an ounce. That's just matching history, not breaking records. So here's the obvious question. If gold's doing its job and breaking free into new reality zones every decade, why is silver still stuck in the same box it's been trapped in for 50 years? That's not a rhetorical question. It's the most glaring anomaly in the metals market today. We've shown chart after chart in our reports, not just of silver, but of base metals like copper and lead. And the comparison is astonishing. In the 1970s, 80s, and 90s, those base metals traded in relatively tight ranges, just like silver has. Then something remarkable happened. Around 2005, copper suddenly exploded. It quadrupled in price within a few quarters and never looked back. It spent the next decade living in a new, higher reality, roughly 4 times the average price it held for the 30 years prior. Lead did the same thing in 2007. It broke out of a multi-decade range, quadrupled in a matter of months, and established an entirely new equilibrium. Not a speculative spike, a structural reset. So why hasn't silver followed suit? Why has this one monetary metal, with both industrial and investment demand, remained in a coma while every other commodity graduated to a new price regime? Now, there are a lot of theories. Some say silver's been artificially suppressed through paper trading, derivatives, and manipulated short positions on the COMEX. And you know what? There's probably truth to that. But history tells us that no market can defy economic gravity forever. Suppression works until it doesn't. Eventually, the dam breaks. Look at the data. In 1980, silver hit $50. 45 years later, here we are again. And silver's still in the high 40s, maybe brushing 50. Meanwhile, gold's gone from $200 to $4,000. Lead is up 4-fold. Copper is up 4-fold. Aluminum, nickel, zinc, all of them have found higher equilibrium zones. But silver, still stuck at the same level it was when Jimmy Carter was in office. Now, does that sound sustainable to you? Markets make mistakes, both on the upside and the downside. We all know that. You've seen irrational exuberance in bubble markets, where assets fly too high for too long. Everyone buys the story, everyone piles in, and only after it crashes does the world say, "Oh, right, that was insane." But the reverse happens too. Markets get irrationally cheap. They sink too low, stay there too long, and everyone forgets why they ever mattered. Then one day they wake up, violently, That's where silver is right now. Dead money that's about to come alive. The technicals justify it. We've identified a very specific trigger level. I'll get to that in a second. But once it's hit, our models suggest silver could quadruple within the following 2 quarters. 6 months, maybe a little more. You could see silver jump from $50 to $200 faster than anyone believes possible. And this isn't just theory. We've seen similar tantrum moves in other markets over the last 50 years. Sudden repricings after years of stagnation. When reality finally catches up to distortion, it doesn't happen gradually, it's instantaneous. Think of it this way. Markets are like compressed springs. The longer they're suppressed, the harder they snap back. And silver's been compressed for half a century.
I think the pullback you just saw is a buying opportunity. Again, when you put it in perspective of what has gold done since the government legalized it. Well, it had a bear market low in 1976 after hitting 200, and when it was legalized, it dropped to $103. Mid-76. Between mid-76 and 1980, 3.5 years, it went up eightfold. And the conditions that drove that, we argue, are far less dynamic than the ones we're sitting on right now. Okay, 2. The next bull market started in 2001 from a $260 low and went to 1920. Eightfold move. Spanned 10 years, but an eightfold move. Okay. We're only fourfold off the bear low, $1,050 in 2015. So people say, oh, it's overdone, it's overdone. There's another argument that it's just beginning. And it's the first charts I sent you. The first chart shows a spread relationship between an ounce of gold and the price of the S&P 500. And it goes back to 2013. Remember, gold peaked at 11, and 2011, 12, 13 especially, it's entered a bear market, which didn't bottom until 2015, end of that year. During that time, it was underperforming the S&P 500. The spread was collapsing along with the net price of gold. But then, in the 11 years since that, during an 11-year period of that basing process, there have been 4 rally highs in the spread, meaning gold has had a rally versus the S&P relative performance-wise. And each of those rallies, by the way, was actually strong upside in gold, net price. But there's a clear base that a kid with a crayon could draw a line across. 4 separate peaks that are almost flat. You're pushing at that line now, again. Right now, the spread between gold and the S&P is 58.6%. Ounce of gold, D's gold, using D's front month future, S&P. If you ever close a month at 60%, and we were intra-month above that last month, you ever close a month out at 60% on that spread breaks out of an 11-year relative performance base. It says, I'm just beginning. Again, when the spread moves up, net price of gold's moving up. So that chart says, as an asset class choice, stock market or gold, it'll break out versus the S&P in saying it's just beginning. And then it's not broken out yet versus the S&P. But we also ran the spread of gold versus the New York Composite Index, which doesn't have a front end weighting of 5 stocks that constitute 30% of the overall index, like S&P, or 5 stocks in the NASDAQ 100 that constitute 50% of that index. Okay. I measured it against the New York Composite and the Dow 30, same time span, 2013 to present. They've broken out. Already gold is broken out versus those 2 unfront-end loaded indexes of the U.S. stock market. The only thing that's kept it from breaking out against the S&P is, again, a handful of those front-end stocks. That's it. That's the only thing. The broad market really gold's broken out. It says the game has just begun. I'm now a better place to be in the stock market.
Here's where things get really exciting. The silver miners. They've been the forgotten children of this bull market, lagging behind their gold counterparts badly. And that's exactly why I think they're the best risk-reward opportunity in the metal space right now. Let's compare. Take GDX, the big gold miners ETF. Back in 2011, it peaked in the 60s. When gold rallied again, GDX broke above that old high and surged as far as $80 before pulling back to around $70. In other words, it doubled in a matter of months. Not years, months, just to reclaim its previous high. That's powerful confirmation that the gold miners are back in the game. Now look at SIL, the silver miners ETF. Its 2011 high was around 90. Where are we now? Still far below that, not even close. Gold miners have said, I'm back. Silver miners are still asleep, but that's exactly the opportunity, because when silver itself runs its tantrum move, and it will, the miners will follow with leverage. Think about what you're really buying when you buy these miners. You're not just buying a company, you're buying ounces in the ground at a massive discount. In effect, you're getting silver exposure at 10 cents on the dollar. When silver's price doubles, these stocks don't just double, they multiply. And when it quadruples, the miners can move tenfold. That's what happened in 2010 to 2011. That's what happened in 1979 to 1980. That's what happens every time silver shifts realities. Now let's address the elephant in the room. Manipulation. Yes, I know, people are tired of hearing about it. The endless paper contracts on the COMEX, the spoofing, the positioning games by large banks. There's truth to it, but manipulation can't override structural fundamentals forever. Just ask the London gold pool in the 1960s. The governments tried to suppress gold's price artificially, and when they lost control, the system blew up. Silver's suppression phase is ending. You can see it in the physical market tightness, the industrial offtake numbers, the rising lease rates, and the fact that every time silver dips, it gets bought aggressively by off-exchange players. So let's paint the picture. Gold is marching toward $4,000 and beyond. Central banks are remonetizing gold quietly. De-dollarizing in real time, the world is losing faith in fiat. At the same time, industrial demand for silver, in photovoltaics, semiconductors, green energy, and 5G, is hitting records. There's no surplus left. The above-ground inventories that used to cushion the market are nearly gone. Now put those together. Monetary panic meets industrial scarcity. That's not a recipe for a slow grind upward. That's a setup for an explosion. Our models show that once silver breaks above its multi-decade range, let's call it the $50 zone, there's no resistance until $100. Beyond that, it could easily overextend toward $150 to $200, just as other commodities like copper and lead have done when they escape their long-term ranges. I've shown this in our reports. Copper was stuck between 60 cents and $1.50 for over 30 years. Then in 2005 to 2006, it quadrupled to $4 in a matter of quarters. Lead did the same in 2007. These aren't speculative tech stocks, they're industrial metals. When they reprice, they don't trickle higher. They teleport. Silver is the last major commodity still waiting for that leap. Let me give you an image to hold on to. Imagine a spring that's been compressed for half a century. Every manipulation, every short sale, every moment of neglect has tightened that coil. Now imagine the lock slipping. What happens next isn't a move, it's an eruption. The most exciting part is that we can see the ignition structure forming right now. The spread between silver and gold, silver divided by gold's price, is about 1.2%. That's historically low. In 1980, it hit over 3%. During the 2011 rally, it hit 2.5%. When that ratio rises, it tells you silver is outperforming gold. The speculative energy within the metals complex is igniting. Once silver closes a month above 1.31% of gold's price, it's game on. That's the breakout line. The same way the Dow Jones in 1982 or the NASDAQ in 1995 broke through multi-year bases and never looked back. So what happens next? Silver runs, gold runs, the miners go exponential, and the mainstream financial media, who have ignored this for a decade, will suddenly pretend they saw it coming. You'll see the same pattern. First denial, then confusion, then euphoria. The retail crowd always arrives in the final act. That's why timing matters. When I say next couple of quarters, I mean it literally. The technical patterns are aligning now, not 5 years from now. Let's talk strategy. If you're a long-term investor, physical silver remains the foundation. You hold it because it's real. No counterparty risk. No algorithm can erase it. But for leverage, and this is key, the miners and longer-dated silver call options are where you get the rocket fuel. This is where I'll make a point that might surprise people. The silver miners right now are priced as if silver will never rise again. They're valued for $25 silver. When silver hits $100, those valuations implode, in a good way. Think about Pan American, Hecla, First Majestic, Endeavor, Mag Silver, companies that have proven reserves, operating leverage, and institutional neglect. They're not hidden gems. They're obvious, but nobody cares on yet. And that's the opportunity. We've entered the recognition phase of a long-term monetary shift. Governments can't finance their debt without devaluing their currencies. Central banks know it. Investors are slowly figuring it out. The result is a migration from paper to hard assets. From narrative to reality, gold's already signaling that shift. Silver's next. Here's a fun way to think of it. In the 1970s, gold was the responsible adult. Silver was the teenager who snuck out of the house at midnight and came back with a tattoo. When the metals bull really gets going, silver behaves like gold on caffeine. That's what's about to happen again.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.